Are we democratizing finance or just fueling a get-rich-quick frenzy? The answer is complicated, but the impact is undeniable.
Zero DTEs are now a dominant force, especially in S&P 500 options, raising big questions about market stability and risk.
The rise of zero DTEs marks a shift from long-term investing to short-term speculation, more like betting on a roulette wheel than building wealth.
What if I told you that every day, traders are betting over $1 trillion on where the stock market will close? This is the world of 0 days to expiration or zero DTE options. These contracts have turned trading into a high-speed, high-stakes game, where fortunes can be made or lost in hours.
Trading zero DTE options is the financial equivalent of live tweeting the news as it unfolds. You're not just reacting to headlines, you're trying to anticipate the market's immediate response, making split-second decisions based on the latest information. It's a stark contrast to reading tomorrow's paper, where you get a retrospective analysis of what happened. With zero DTE options, you're in the thick of it, experiencing the market's volatility firsthand.
Zero DTEs aren't about long-term strategy or building a diversified portfolio for retirement. They're not about carefully analyzing company financials or economic trends over months or years. Instead, they're about reacting to the market's pulse in real time, capitalizing on short-term fluctuations and immediate market sentiment. It's a high-stakes game of predicting where the market will move in the next few hours, or even minutes.
The value of these options melts away minute by minute, like an ice cube on a hot summer day. Time decay, or theta, is a major factor here, eroding the option's premium as the expiration time approaches. If you're not in the money fast, your premium vanishes, leaving you with nothing. This rapid decay demands quick and decisive action. For sellers, this rapid decay is an opportunity to profit from the time value erosion, especially if the underlying asset remains stable. But for buyers, it's a race against the clock, a constant battle to outpace the relentless march of time. Every second counts.
Unlike traditional options, which give you weeks or months for your bet to play out and allow for market corrections, unexpected news, or gradual trends to unfold, zero DTEs are all or nothing by the end of the day. There's no tomorrow. Your position is either profitable or worthless when the market closes.
So, what exactly is a zero DTE option, and why has it become such a popular, albeit risky, trading instrument? At its core, it's a standard options contract that gives you the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, known as the strike price. The key difference is that it expires today, by the closing bell, making it a very short-term speculation. Imagine compressing weeks, or even months, of potential market movement and economic news into a single high-pressure trading session. That's zero DTE, 0 days to expiration. It's a high-risk, high-reward game that demands precision, speed, and a deep understanding of market dynamics. The long-term strategic vision, the careful planning, the patient accumulation of value over years, all of that is out the window. The immediate, the now, the split-second decision, that's what dominates the market narrative today.
This isn't just seasoned professionals hedging their portfolios anymore. It's a whole new ballgame. The old rules don't apply. Retail traders armed with commission-free apps and a thirst for quick gains are now major players, wielding significant influence. They're not just along for the ride, they're driving the bus. This influx of retail participation is driving a fundamental shift in market structure, creating unprecedented volatility and unpredictable price swings. The market is becoming more reactive, more sensitive to short-term sentiment.
The question is simple, stripped down to its bare essence. Will the market, specifically the S&P 500, go up or down today? It's a daily gamble, a high-stakes poker game played out in real time. That's what $1 trillion, a mind-boggling sum of capital, is trying to answer and profit from every single day. It's a constant tug-of-war between bulls and bears, fueled by speculation and short-term bets.
The S&P 500, the benchmark of American capitalism, is now the perfect playground for this daily drama, a stage for fortunes to be made and lost in the blink of an eye. It's big, with immense trading volume. It's liquid, allowing for easy entry and exit. And it's predictable enough, or at least perceived to be, for mass speculation to thrive. This creates a self-fulfilling prophecy. where speculation drives the very price movements that speculators are trying to predict.
On many days, over $1 trillion worth of these contracts, representing enormous leveraged bets, change hands. A staggering figure that underscores the sheer scale of the speculative frenzy. It's an incredible amount of leverage, concentrated and focused on capturing just a few hours or even minutes of price action. This creates a highly volatile and unpredictable environment, where even small events can trigger massive market swings.
This explosion of short-term speculation was largely enabled when exchanges started offering daily expirations on options contracts, a seemingly small change that had profound consequences. This innovation effectively turned every single trading day into a brand new opportunity for high-speed, high-stakes bets, fueling a surge in speculative trading activity.
Zero DTE, or 0 days to expiration, trading isn't just a fleeting trend or a passing fad. It's a fundamental revolution in how the market operates. These ultra-short-term contracts now make up over half of the daily S&P 500 options volume, dominating the market landscape and shaping price movements. This is a meteoric rise, up from almost nothing just a few years ago, demonstrating the speed and scale of this transformation. The market has fundamentally changed, and zero DTE options are at the heart of it.
The line between crowd wisdom and herd mentality has never been blurrier.
Influencers hyper-trade, followers pile in, and sometimes the crowd itself moves the market.
Retail traders, once sidelined, are now a force that can move markets, especially when they act together.
Zero DTEs became the ultimate lottery ticket, quick, risky, and perfect for screenshot bragging rights.
The pandemic supercharged this trend, with people at home, stimulus checks in hand, and markets surging.
Commission-free apps like Robinhood made trading as easy as tapping your phone, removing barriers for millions of new traders. Social media, Reddit, TikTok, YouTube, turned trading into entertainment, with viral stories of huge wins and losses.
The zero DTE boom is the result of two forces, technology and culture. The market's shock absorbers are being tested by a force that barely existed a few years ago.
Regulators worry that this intraday volatility could spill over, creating systemic risks the market isn't ready for.
A viral post or news event can spark a cascade of hedging, turning a small move into a big wave.
Sometimes the market seems magnetically drawn to certain price levels, pinning because of where options are set to expire.
This can trigger gamma squeezes or sudden drops, especially near the close, as dealers scramble to adjust.
When traders pile into calls or puts, market makers must hedge by buying or selling the underlying asset, amplifying price swings.
Experts agree, zero DTEs can supercharge market volatility. For zero-day traders, a tiny move can mean a 1,000% gain or a total loss, often in minutes.
For some, it's a windfall. For others, a wipeout. The leverage cuts both ways.
These moves aren't about fundamentals. They're about the internal plumbing of the options market.
Picture this. The market is flat, but a small news blip pushes SPY down, suddenly putting a huge batch of put options in the money. Dealers rush to hedge, selling futures, which pushes prices down further. A self-reinforcing spiral.
We've already seen the impact. Mini flash crashes in stocks like NVDA and ETFs like SPY, often linked to zero DTE mechanics.
Success requires skill, discipline, and risk management, far beyond what most casual traders bring to the table.
Most retail traders underestimate these risks, turning their accounts into cautionary tales.
You need to be right, and you need to be right now.
Then there's theta, or time decay. Every minute your option loses value, especially if it's out of the money.
Even commission-free trades have hidden costs. The bid-ask spread. Trade enough, and these add up fast. Gamma is the wild card. A small move in the underlying can make or break you instantly. The value of your option can explode or collapse to zero in seconds.
Three forces work against the retail zero DTE trader: transaction costs, gamma risk, and relentless time decay. In this game, survival is a win.
These steps won't eliminate risk, but they'll help you avoid disaster.
Consider trading options on broad ETFs like SPY or QQQ, not individual stocks, to reduce single company risk.
Have a plan. Know your entry, target, and stop loss before you trade. Stick to it no matter what.
Resist the hype. Social media shows the wins, not the losses.
First, size your positions conservatively. Risk only a tiny fraction of your capital on any trade. Use zero DTEs for hedging, not just speculation. A put can be cheap insurance for a big portfolio.
If you're determined to trade zero DTEs, a few rules can help you survive.
In the world of finance, managing your risk isn't just a suggestion. It's an absolute necessity. It's the cornerstone of any successful trading strategy, the shield that protects your capital from unforeseen market storms. Because if you don't proactively manage your risk, the market, with its unpredictable nature, will most certainly do it for you, often with harsh and unforgiving consequences.
Therefore, approach zero-day options with extreme caution. These instruments are not for the faint of heart, because if you don't, you may very well find out the hard way, through painful losses and sleepless nights, just how quickly things can turn against you. You'll learn just how fast fortunes can change, evaporating before your eyes in the blink of an eye. The market doesn't discriminate. It treats everyone the same, regardless of experience or capital.
The zero-day market, with its allure of quick profits and high leverage, isn't going anywhere anytime soon. It's here to stay, a permanent fixture in the financial landscape. But remember, your capital, unlike the market's opportunities, is finite. It's a limited resource that must be carefully managed and protected.
Therefore, before you even consider placing a trade, take the time to educate yourself thoroughly. Knowledge is your most powerful weapon in the market. Learn the Greeks, delta, gamma, theta, vega, and understand how they impact your options positions. Study risk management techniques such as position sizing and stop-loss orders. And most importantly, practice before risking real money. Use a demo account to simulate trading and refine your strategies without putting your capital at risk.
These are not tools for beginners. Zero-day options require a level of understanding and experience that most novice traders simply don't possess. They demand deep knowledge of options pricing, market dynamics, and risk management. They also require unwavering discipline, the ability to stick to your plan even when emotions run high. And above all, they demand a profound respect for risk, an understanding of the potential for significant losses.
The odds are often stacked against the casual speculator who lacks the resources, information, and expertise of institutional traders. And the market itself is often more volatile because of these trades, creating a feedback loop that can amplify both gains and losses.
The thrill of a winning trade is undeniably real, but so are the dangers of overconfidence and reckless risk-taking. Statistically, most traders lose money trading options, especially those who are new to the game or who lack a solid understanding of risk management. And the risks extend beyond the personal level. They are systemic as well, potentially impacting the stability of the entire financial system.
Zero-day options are the ultimate expression of our fast-paced, gamified financial world. A world where instant gratification and high-stakes gambling often overshadow prudence and long-term investing.